Are you getting ready for retirement or under the age of 50? This is the video for you. We're going to be talking about a dividend stock ETF and really why you should be building it coming up to retirement. And of course, there are some very crucial steps when you're building this out for not only now, but also to benefit in the future. Many people under 50 overlook the importance of investing early. If you start in your 20s and 30s, your portfolio is going to be exponentially larger, only focusing in a younger generation on really target date funds or even looking at stocks specifically that can be very volatile through history. Now, it's a very common mistake that getting growth stocks very early can be exciting, promising. A lot of people looking at Nvidia, looking at all of these big growth stocks, but the problem is they come with a much higher volatility that a majority of people cannot stomach when they're going up and down. If we see the market pull back 10 or 20% on a good growth stock, a lot of people will pull out of the market. They won't go back in because the market can fluctuate wildly if you're investing in only one stock. Now, if you're not careful, you can start losing money instead of gaining it, which I did this at a very young age, got used to it and really stomach it now as the stock market goes up and down, continuing to put contributions in there and building up the stock ETF portfolio. Now, if you're under 50, you need to think about the long game, especially again, if you're 20s, if you're 30s, having a portion of your investments into something that is going to pay you dividends. If you're young, time is on your side, and that is the most powerful advantage when it comes to compounding interest and when it comes to investing in general. The earlier you start, the more time your money has to grow, resulting in you having to worry a lot less about your financial security when you start getting into your 50s, your 60s, 65, when you start getting into retirement. But if you wait too long, you'll be missing out on all of the benefits that we see, and this can make a huge difference on your return over time. That is honestly the reason you want to start achieving that financial independence as soon as possible and not overlooking it. So what is your alternative to buying these growth stocks or the growth ETFs? This is where the dividend investing comes in, type of investment that can provide income and has a lot of stability rather than just growth. And in addition to something like the SCHD, we do see a steady, reliable income from blue chip companies, and we also see a little bit of growth. So it's a best of both worlds for some of those. Now, dividend stocks and ETFs are often overlooked by a younger generation, but we're starting to see a big shift to the income generation and being able to essentially replace that 9-to-5 income that people traditionally work for with passive forms of income through actively investing. Now, by investing in dividend ETFs, you can create a steady stream of income that can help you achieve that financial stability without having to worry about the volatility of the growth ETFs or the growth stocks that we do see, again, some really large ups like the last 2 years, but we also see some really big pullbacks like 2022. Now, when we start looking at the advantages of these dividend ETFs, such as the passive income, the compounding returns, lower volatility, and also they need to fit in your overall investment strategy. We have talked about this before. When it comes to the 3 ETF portfolio, you can almost picture it as 3 legs of a stool. The first one is, of course, your foundation ETF. This is going to be the VOO. This is going to be the SPY. This is going to be something that is based in really looking at the S&P 500 index. Now, the reason for this is it is a foundation. You are investing into the 500 largest companies within the United States, and this is going to give you the foundation for all of the sectors, all of the diversification that you do need built out with an ETF. That is the reason why this is the foundation. Now, the second one we look at is, of course, that growth aspect. When you start looking at a longer time frame, 20, 30, 40 years to retirement, growth is going to be needed. There is going to be a point when you're under the age of 50 where growth is going to be very important with these ETFs. And there's also a point where you'll be looking into this third leg of the stool or the third piece of the 3 ETF portfolio, which of course is the dividend ETFs. So what I have started to do, and this is very important because it is the way that I am really poising it and the way that I have really built it, is when you start getting closer to retirement, you can start moving money and really mitigating your high risk volatile assets of those really big growth ETFs like the VUG, pulling money or pulling percentages out of there and starting to put a lot more into the VOO and putting a lot more into that SCHD, making it more about dividends and about kind of the solid performance of the VOO that we've seen, the roughly 10% return, which again, we don't see a massive downside. Now, of course, when you start looking at this and looking at things like the SCHD, like we had said, they're in 100 different companies which are not very prevalent when it comes to some of those growth, because of course, we are looking at the larger companies like your Home Depot that have been paying dividends for a multitude of years, Coca-Cola that have been increasing dividends for a multitude of years, meaning it is going to give you a very good interest generating machine. Now, another advantage of those dividend stocks is the compounding returns. When we think of an investor like Warren Buffett, which of course is one of the most famous investors ever, it means your money can grow exponentially over time. When you think about his investment on Coca-Cola and literally just rolling that for the last 30 years over and over and over, now he's getting hundreds of millions of dollars in dividends into Berkshire Hathaway and his personal portfolio, which is kind of crazy because dividend stocks pay out a portion of the earnings to shareholders in the form of dividends. You're really getting a paycheck from the company that you're holding the stock, or if you're holding a basket of stocks in that ETF, you are getting paid out. And of course, that money is reinvested into more returns. So when it gets to a certain point though, and you're changing up the dividend and the percentage that you have in that portfolio, there's going to be a point where I can put a lot of that growth ETF into something that is going to pay me dividends. The dividend yield that I'm getting and getting returned to me is going to be what we're using to supplement our Social Security and really not having to work that 9 to 5. With, again, that dividend stock portfolio, looking at the lower volatility that it offers, might learn a little bit less in the short term, which means you can focus on longer term growth with the investments and really building up that portfolio. So when it comes to these dividend ETFs, it is an overall investment strategy that is only part of the 3 parts we talked about. And the key is diversify your portfolio. This is the reason why I do not put my eggs in one basket, why I do put them into ETFs. Not only do they have an incredibly low expense ratio with those ETFs, but by really spreading them out into a couple different sectors or a multitude of sectors between 3 different ETFs, you can really have access to a lot of dividend paying stocks. You can have growth stocks. You can have a lot of things in those portfolios that are going to grow with time. It helps you manage risk right off of the bat and also looks at poising the potential returns without having quite the big upside and the downside. And you'll have us generating a steady stream of income, which is exactly what I'm doing. If you get to the point of having, $200, $500, $1 million in something like the SCHD when you go to retirement, you can supplement your income in its entirety with just the one ETF that you're going. So of course, the very key insights that we have from this video is early investing. That is the biggest thing to generate income, really building wealth over time and being very reliant and not really less reliant or not really reliant at all on the Social Security income that could or not be there. Again, that is a big question mark for a lot of the younger generation. You have the luxury of time. If you're in your 20s and 30s, you can take advantage of that compounding interest. You can build your wealth over time, and investing in those dividend ETFs, you can generate a steady stream of income to achieve financial independence sooner than later. The best part is you don't have to be a financial expert. You don't even have to pay anyone to manage all the mutual funds for you, because when it comes to index investing, it is very simplified to what you can look at. Do your own research, know exactly what you're putting your money in, because to sum it up, starting a dividend ETF portfolio under 50 can provide financial security and peace of mind as you get closer and you approach retirement. This is a way to really take control of your finances, building and growing your wealth over time. And of course, the earlier that you start, the more advantage and the bigger advantage you're going to be able to take with the compounding interest and achieving that financial independence. So if you found the information in this video helpful, please check out the videos on the dividend ETFs that we have, 3 ETF portfolio. Let me know in the comments what you guys think. And as always, thank you guys for watching.